Welcome to the deep dive. So India's economy, wow, just posted some really incredible number. We're looking at 7.8% GDP growth for the first quarter of fiscal 26. That's the best in 5 quarters. And, much higher than anyone really expected. Analysts were thinking maybe 6.5%, something like that. So yeah, blew past forecast. Today, we're really digging into how did India actually hit the surprising number? Okay, let's unpack this.
Yeah, it's fascinating, isn't it? Because this exceptional growth, well, it wasn't just pure economic muscle, let's say. It was more like a unique mix. You had solid structural things happening, sure, but also some factors that were, frankly, temporary. Geopolitical stuff even playing a role. Our mission today is to kind of tease those two strands apart for you so you can see the full picture.
Right. That's a really crucial distinction to make up front. So, okay, let's start with those structural drivers. What were the big foundational pieces pushing that growth?
Well, a massive factor you can't ignore was public capital expenditure. The government really front-loaded its spending. We saw a huge, 52% jump year on year just in Q1. That was deliberate, a policy choice, and it laid a strong foundation for that headline number. Then you also had pretty impressive resilience in some key sectors. Services, for example, just kept powering ahead, up 9.3%, really strong. In manufacturing, that had been a bit sluggish, but it posted 7.7% growth, best it's done in 5 quarters. Even agriculture did okay, up about 3.7%.
Those numbers do sound strong, definitely paint a picture. But does that mean everything was firing on all cylinders? Was it sort of uniform strength?
Well, those headline numbers, they look good, but you have to connect it to the bigger picture. Because when you look underneath, you start to see it's a bit uneven. Some foundational bits, like mining, that actually shrank, down 3.1%. And utilities, like electricity, barely grew, just 0.5%. So it kind of suggests, while the consumer-facing services and the construction boosted by public money are doing well, the underlying basic industries might be lagging, which tells you the growth isn't quite reaching everywhere yet, not broad-based.
Okay, that adds some important nuance there. Now, you also mentioned these unique temporary factors, the things giving an extra kick. What were those?
Right. So one really significant one was exports, specifically to the U.S. We saw India's exports there jump by almost 23% in Q1. And this is key. It wasn't because global demand suddenly surged. No, it was exporters basically rushing to get shipments out before August 27th. That's when new, pretty hefty U.S. tariffs were set to hit, another 25% duty. So this front-loading, shipping early, it created a kind of artificial bump in the export numbers. Yeah. Purely timing.
Okay. So a temporary surge driven by trying to beat the deadline makes sense. And you also mentioned something about a crude oil dividend, another temporary factor.
Exactly. This is another big help. India kept buying that heavily discounted Russian crude oil. And because of that, its total crude import bill actually dropped by 18.6%. That's a saving of $7 billion. Huge. It's kind of an ironic example, isn't it? How these big geopolitical shifts can create these unexpected, arbitrage opportunities for some countries.
Yeah.
And that saving, that $7 billion, it helped India manage its current account deficit, the gap between foreign money coming in and going out. And just as importantly, it helped keep a lid on domestic inflation. Inflation fell to 1.55% in July. That lower inflation gave the Reserve Bank of India room to maneuver, maybe ease monetary policy, which helps credit growth and investment.
Okay, so you have these impressive figures on one side, but then these nuances and contradictions, like this puzzle around consumer spending. You hear talk about a consumption-led recovery, maybe? But the actual data for real private final consumption expenditure, that's basically consumer spending, adjusted for inflation, and it's nearly 60% of India's GDP, that actually slowed down. It grew 7.0% in Q1, down from 8.3% the year before. So what's going on there?
Yeah, that points to a really critical challenge, I think, this impressive headline growth. It seems quite split, bifurcated. You've got public spending, driving infrastructure, top-end services doing well. But the broader population, especially folks in less secure jobs, lower wages, the unorganized sector, they don't seem to be feeling that uplift in their spending power as much. There's maybe a confidence gap. And that could hold back domestic demand down the line. And what's also a bit worrying is that threat from the U.S. tariffs we mentioned. Analysts are warning that could cost potentially hundreds of thousands of jobs, particularly in those labor-intensive export areas like textiles, gems, jewelry.
So putting it all together, what does this mean for you listening? Q1 for FY26 was, undeniably impressive for India, a strong number. But the momentum behind it is, it's complex, isn't it? And maybe a bit fragile because of those temporary boosts and the external risks looming.
Exactly. And it really raises a crucial question looking forward. With those temporary factors like the export rush and the oil discount likely fading, and these external risks, like tariffs, still out there, How can India actually use this Q1 momentum? How does it accelerate the deeper structural reforms needed to build an economy that's truly resilient, to future shocks, geopolitical or otherwise? What's it actually going to take to make sure this growth becomes genuinely broad-based?
Sustainable. Something for you to think about, really.
Mhm.
As India makes a strategic pivot towards more domestic reforms, diversification, maybe that's the long-term opportunity.